This is Macro Horizons, episode 386, Debating in Silence, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Vail Hartman and Delaney Choi to bring you our thoughts from the trading desk for the upcoming week of August 10th. Warsh's campaign against forward guidance will be acutely felt in the wake of payrolls and the upcoming CPI report, leaving investors who have been accustomed to reading the proverbial Fed tea leaves with an empty pot, as it were. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, in addition to the payrolls print, which frankly speaks for itself, we had a few important updates in terms of the direction of Treasury issuance as well as the general geopolitical environment. First, we'll highlight Wednesday's quarterly refunding announcement. The relevant auction sizes, 3s, 10s, and 30s, were left unchanged, which was widely as anticipated. Within the statement itself, the Treasury Department retained the several quarters language, which reinforced the market's assumption that 10, 20, and 30-year coupon auction sizes won't be increasing for the foreseeable future. The Treasury Department also shifted one specific piece of language that is notable. When talking about future adjustments to coupon auction sizes, they replaced future increases with future changes. This can be interpreted in one of two ways. One is that in keeping with the trend in Washington, started by Warsh, to pull back on forward guidance, the Treasury Department has taken its cue from the recent FOMC statements and shifted the language simply to avoid messaging any future direction. Another interpretation is that Bessent changed from increases to changes to give the Treasury Department the option at some point of reducing the size of longer-dated coupon auctions. 20s and 30s come to mind, particularly given the elevated outright level of yields at the moment. It's also clear that Treasury Secretary Bessent is willing to use the Treasury Department's WAM, or weighted average maturity of issuance, more actively than prior Treasury Secretaries have. We don't think that there's any particularly strong implication for the very near term as it relates to issuance, but nonetheless, it was an interesting shift and one that has added a bit more optionality for Bessent. Geopolitics also remained very front and center for the market over the week just past, with the prospects for a deal related to the Strait of Hormuz and the potential to free up tanker traffic from the Persian Gulf have to a large extent been driving the macro narrative. And until there is a track record of a deal that has been successful in reopening the waterway, the U.S. rates market is likely to remain somewhat vulnerable to headlines from the Middle East, and with retail gasoline prices still above $4 a gallon, it's safe to assume that the midterm elections are now in focus for the administration, and we'll be eager to see how that plays out as it relates to Trump's foreign policy, specifically in the Middle East.
Well, the most notable event of the week was the negative July payrolls print, which furthered the constructive tone in the Treasury market that we saw begin earlier in the week, with headlines indicating progress towards a peace deal between the U.S. and Iran, then away from a peace deal, then towards a peace deal again. The front-month WTI contract spent most of the trading week below $80 a barrel. Treasuries have continued to trade in lockstep with oil, and equities pushed to fresh record highs on optimism that a deal was imminent. We saw the August refunding announcement retain the next several quarters language, but the predominant driver of the macro narrative was by far and away the payrolls report, which brought September hike pricing down below 50%.
All else being equal, the payrolls report should have taken a September rate hike off the table. But the reality is, the argument for hiking in September is an inflation story, not a job story. Yes, there's been weakness in headline payrolls, but to some extent, a few of the details suggest that monetary policymakers might be able to explain it away. Specifically, while private payrolls underperformed expectations, they were still positive, increasing 30,000 in the month of July versus 30,000 in June as well. One of the big drags came in the form of government payrolls, specifically local government education, which was frankly a school year story. All of this suggests that if we do see a rebound in payrolls for the month of August and core CPI errs on the higher than expected side, that a rate hike might still in fact be on the table. Taking a step back, however, the combination of the June payrolls print and the July payrolls print suggests that clearly there's something going on in the labor market. Adding to the case for monetary policymakers to downplay the July employment report was the fact that the employment rate unexpectedly declined 0.1% to 4.1%. Now, this was largely driven by the fact that the labor force participation rate also dropped 0.1%, reaching the lowest since February 2021, but outside of the pandemic, the labor force participation rate is now at its lowest since March of 1976, i.e. a 50-year low. There's been a lot of debate about the divergence between a lower unemployment rate and what we've seen with headline payrolls. Concerns abound about participation in the survey as a result of some of the immigration reform. So while we would be content to take this report at face value, the reality is that there are some cross currents within the details, which still leaves the Fed's focus on the trajectory of core inflation during July and August.
And it's notable that the consensus for July's core CPI report, which is released on Wednesday, is just 0.2%, a fairly benign level.
And within the quarterly refunding statement, nominal coupon auctions were left unchanged, and the several quarters language was retained for the 11th consecutive quarter. Now, this effectively served to delay market expectations for nominal coupon auction size increases until the second half of 2027 or later. For the time being, Bessent appears committed to using the bill market to fund additional government borrowing needs. Whereas most of the refunding statement was in line with expectations, there was a very subtle change where the Treasury said that it is evaluating potential future changes to auction sizes, before the phrase read potential future increases. The shift away from the word increases to changes could simply be a transition away from forward guidance, or it could be laying the groundwork for something as unexpected as lowering longer-dated coupon auction sizes. Reducing long-end issuance is not our current expectation, and we'd caution against placing too much weight on this minor language tweak as a precursor to future reductions in bond issuance, even if the change technically implies a non-zero probability of auction cuts. It's worth highlighting that the Treasury Department has used the terms adjustments and changes in refunding statements in recent years, both with and without specifying whether future moves would be increases or decreases. Despite any uncertainty that might have been triggered by the minor language tweak in the statement, TBAC is still advising the U.S. Treasury that increases to coupon issuance could be warranted in fiscal year 2027. In fact, the committee formally recommended that Treasury consider updating its forward guidance language to preserve flexibility heading into fiscal year 27. Note that no such recommendation was formalized in last quarter's report to the Secretary, despite the discussion of potential changes to forward guidance in the May TBAC minutes. If nothing else, Bessent appears comfortable diverging from TBAC's recommendations.
However, as a counterpoint, we'll point out that within our recent client survey, 61% of respondents anticipated that the next move in 30-year auction sizes will be a decrease rather than an increase.
And while we didn't get any specificity regarding the timing of the next change for long bond auctions, that is a notable shift in the market's perception of how the Treasury Department is going to be managing issuance going forward. A more active management of the weighted average maturity of outstanding treasuries might ultimately be a hallmark of Bessent's time at the Treasury Department. But for the next several quarters, at least, it seems the Treasury Secretary is content to simply wait and see and rely on the bill market.
And another change on the part of the Treasury Department has been its willingness to intervene alongside the MOF to defend a struggling Japanese yen. And Treasury Secretary Bessent has called on the Fed to increase the size of its FEMA repo facility so that Japan can raise dollars without selling some of its more than $1 trillion of Treasury holdings. At this stage, it's an open question whether the Fed will follow through. We took the opportunity to ask whether the Fed will lift the borrowing cap on the repo facility in our monthly client survey. Ultimately, 83% of respondents said they anticipate the Fed will expand the facility, whereas 17% don't expect it to be upsized. Regardless of the Fed's actions with the repo facility, Bessent's push to prop up the Japanese currency while attempting to limit official selling of U.S. treasuries is a testament to how concerned the Trump administration is with the recent weakness in the long end of the Treasury market, as well as how far the administration is willing to go to contain U.S. borrowing costs.
It's also interesting that it does raise a question about coordinated action between the Treasury Department and the Fed. Increasing the FEMA facility does follow intuitively given everything that's going on in Tokyo at the moment. However, because Bessent has been so vocal about increasing the facility, there has been increased concern that the coordination between the Treasury Department and the Federal Reserve undermines the credibility of the Fed at a moment in which Warsh is trying very deliberately to make sure that the central bank is viewed as independent.
There have been a lot of changes at the Fed recently, and the pushback against forward guidance has posed something of a wild card for credibility. It's been interesting to see reports that Kevin Warsh has floated the possibility of changing the frequency of FOMC meetings to his colleagues at the Fed. One idea he raised was to meet 6 times a year to decide on interest rates instead of 8. Now, there haven't yet been any formal proposals to change the meeting schedule because the discussion has been merely exploratory at this stage, but it is clear that there's some appetite to re-examine the meeting schedule among committee members. For example, on Tuesday, Philadelphia Fed President Anna Paulson said that she's open-minded about the prospects for less FOMC meetings, but she first wants to get a better understanding of the trade-offs of 6 versus 8 meetings per year. And so it'll be interesting to see if Warsh's communications task force has anything to offer on the issue later this year. One obvious implication of fewer FOMC meetings is that there would be fewer opportunities to adjust policy rates in response to an ever-changing economy. So, for example, in a scenario where inflation unexpectedly surged, the Fed could potentially find itself waiting longer than it should to hike interest rates. And unless the Fed announced an unscheduled emergency meeting, you could end up with untimely policy action.
It's also worth highlighting that Warsh does technically have the ability to change the number of meetings without an FOMC vote. The only requirement by Congress is that the FOMC meets 4 times a year to discuss policy rates. However, in practical terms, we expect that Warsh would bring the issue to the FOMC as a whole for a vote, if for no other reason than to get buy-in on the part of other monetary policymakers, which would help the ongoing process of consensus building, which at least thus far he seems to be reasonably successful at.
On the topic of consensus building, there's been a debate in the market about whether AI is increasing or decreasing R-star. Whereas many have argued that an AI-driven productivity boom will prove disinflationary in the long run, recent Fed research has found that AI is moderately heating up today's economy while we wait for the likely bumpy rollout of productivity gains. Research has also found that the most AI-relevant price categories display no ground-level signal of productivity leading to disinflation. In fact, it's quite the opposite, and the data shows that AI is currently stoking inflationary pressures. Given that it will take years for AI's impact on productivity growth to be broadly reflected in the aggregate data, the Fed has been left to focus on AI's immediate impact on investment spending, the wealth effect, and inflation. The bottom line is that AI is unlikely to provide any credible argument for rate cuts unless and until there is clear evidence that higher productivity growth will ease inflationary pressures. Whether it does is very much an open question, but if the outright level of nominal rates offers any indication, the market is skeptical.
Well, one could argue that the combination of the June and July payroll prints suggests that there is some shift in hiring momentum that while it might not be linked directly to forward AI productivity expectations, the narrative of needing a smaller workforce going forward certainly isn't helping the trajectory of hiring.
And the debate around R-star has, in part, allowed stocks to shrug off five-handle bonds. So for context, we've seen 24 consecutive trading days where 30-year yields have closed with a five-handle, which is the longest streak since 2007. At the same time, the S&P 500 rallied to a record high this week on the back of U.S.-Iran deal optimism. So it's been interesting to see stocks appear less sensitive to 30-year yields in five-handle territory than last May, when 30-year yields tested 5% and we saw a sharp sell-off in stocks, the same pattern that we saw in the 2023 episode.
So taking this all in the context of the evolution of monetary policy expectations, we remain constructive on the Treasury market over the course of the next several quarters, with an acknowledgement of the fact that the inflation narrative does continue to illustrate the risk that there could be some upside in nominal rates in the near term, and perhaps the floor for nominal rates has been increased in the event of a Treasury market rally into the end of the year. The shifting trajectory of the employment landscape does conform well with our medium-term constructive outlook on the Treasury market, although inflation remains a wild card, and we will need to see the August payrolls numbers before the market is truly convinced that there's a bigger shift afoot.
Like the game is afoot?
Elementary, Vail. Elementary.
I learned that in school. In the week ahead, on the data front, the market will have a great deal of fresh information from which to take trading cues. Specifically, CPI on Wednesday will further contribute to the argument either for or against a rate hike in September. For context, headline CPI is seen increasing 0.2% in the month of July, and core CPI is also seen up 0.2%. We'll argue that an as-expected read on core consumer prices will be sufficient to keep a Fed pause in September in play, but also doesn't take a potential rate hike off the table in the event that August core CPI numbers come in firmer than expected. We'll also have the PPI series on Thursday. Headline PPI is expected to increase 0.2% as well, with core PPI seen up 0.3%. Now, there is some incoming Fed commentary, but given Warsh's pushback against forward guidance, for all intents and purposes, the market will be left to interpret and digest the incoming inflation data without any incremental influence by policymakers. On the consumption side, we'll also see July's retail sales print on Friday, which is expected to show a more modest gain at 0.3%. Still positive, still consistent with a consumer that is on strong footing overall, but certainly not a level that would change the macro narrative. This full data calendar occurs with the backdrop of the August refunding. Up first will be Tuesday's 3-year auction at $58 billion, followed by the $42 billion 10-year on Wednesday, and capped with the $35 billion long bond on Thursday. As a theme, we generally expect that there will be sufficient demand to underwrite Treasury supply. Nominal coupon auction sizes haven't been increased since Bessent took over as the Treasury Secretary, and we don't expect that they will be increased in any meaningful way for the foreseeable future. As the quarterly refunding announcement confirmed, the Treasury Department plans to keep auction sizes steady for at least several quarters. In practical terms, that means that the first increase in coupon auction sizes that one might expect would be during the second half of next year. So as an immediate market influence, we don't think that the supply story is truly poised to reprice the longer end of the nominal curve materially higher in rates. However, fiscal concerns are not limited to the U.S., and given what's going on with JGBs and gilts and EGBs, we'll argue that the broader lingering concerns about supply will raise the floor in terms of how low 10 and 30-year yields could go in the event of a rally, but won't in and of themselves be sufficient to materially increase term premium from current levels unless and until we see a shift away from the conversation regarding Fed rate hikes and in its place refocusing on keeping policy rates at current levels for the foreseeable future. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As we look forward to the balance of August, we're reminded of the importance of sunscreen, staying hydrated, routine tick checks, and a healthy fear of the outdoors. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.